There's a quiet pattern running through 600 years of financial history, and it has never failed, not once. The Portuguese Real, the Dutch guilder, the British pound. Each one rose to dominate global trade. Each one enjoyed a period where its elites genuinely believed our money is different, our system is permanent. And every single time the story ended the same way: debt, debasement, loss of confidence, and then replacement. The uncomfortable truth? The US dollar is now walking the exact same path. It became the world's reserve currency in 1944. That was 81 years ago. The average lifespan of a reserve currency is 80 to 110 years. And based on the same 7 stages that destroyed its predecessors, the dollar is no longer in its golden age. It's in late middle age, firmly in stage 5 and already sliding towards stage 6. This isn't about doom for clicks. It's about pattern recognition. The math that broke every reserve currency before us is the same math running underneath the dollar today. In this video, we're going to walk through the 7 stages step by step, show you exactly where the dollar sits right now, and what that means for your savings, your future, and the next global money system. Most people think strong currency and reserve currency mean the same thing. They don't. A strong currency is valuable. A reserve currency is unavoidable. Bangkok, a reserve currency, is the money other central banks store in their vaults. It's the unit used to price oil, wheat, copper, and almost every major global commodity. It's the language global trade is written in. If you want to buy energy, settle trade imbalances, or park national savings in safe bonds, you do it in the reserve currency. That status creates something economists politely call exorbitant privilege. You get to print paper and swap it for other people's real stuff: cars, oil, microchips, food. Other countries must work, export, and sacrifice resources to earn your currency. You just keystroke it into existence. So every empire fights to gain this position. The Portuguese Real had it. The Dutch guilder had it. The British pound had it. Today, that role belongs to the US dollar. But built inside that privilege is a hidden timer. The same dynamics that bring a currency to the top eventually push it off the cliff. To see why, we need to walk through the 7 stages all reserve currencies travel, whether their leaders realize it or not. Stage 1 never starts with spreadsheets. It starts with ships and guns. Every reserve currency begins with a simple fact: whoever controls the world's trade routes controls the world's money. In the late 1400s, Portugal cracked open the map. Their navigators learned to cross open oceans, round the Cape of Good Hope, and punch through to India and Asia, while everyone else hugged coastlines. They didn't just sail there, they fortified it. Cannon-lined strongholds in Goa, Malacca, Mozambique, and Macau turned sea lanes into Portuguese toll roads. If you wanted spices, silk, or porcelain, you paid through Portugal, and you paid in reals. The Dutch copied and upgraded the model. The Dutch East India Company wasn't just a company. It was a private empire with its own army, navy, and captured ports. Amsterdam became the hub of world trade, and the guilder became the ticket to participate. Then Britain perfected it. Britannia rules the waves wasn't a slogan, it was math. The Royal Navy sat on every major choke point: Suez, Gibraltar, Singapore, the Straits of Malacca. If it moved by sea, Britain touched it. After World War II, the United States inherited that role. Today, U.S. carrier groups patrol every ocean and sit near every critical strait. That's not about freedom of navigation alone. It's about ensuring the global system cannot function without U.S. approval and without U.S. dollars. Once you control the trade routes, the money starts flowing toward you. Stage 2 is where the future reserve currency becomes the world's chief exporter and warehouse of wealth. Portugal used its early advantage to suck riches out of Asia and Africa. Ships left loaded with silver and gold came back packed with high-value goods and sold them across Europe at huge markups. The trade surplus made Lisbon glow. The Dutch took this to another level. Amsterdam became the world's storage unit. Goods from 3 continents piled into its ports. Dutch merchants bought cheap in one region, sold high in another, and skimmed the difference on a planetary scale. The result? Merchants richer than kings, and a currency, The guilder everyone wanted. Britain's 1800s export machine was even more powerful. It sold textiles, steel, ships, and machines to the world while importing low-cost raw materials from its empire. The surplus made London the financial capital of the planet. From 1945 to about 1970, the U.S. played the same role. The factories of Europe and Japan were bombed. American industry was untouched. The world bought U.S. cars, steel, machinery, and consumer goods and paid in dollars. Gold flowed into U.S. vaults. At one point, America held the majority of the world's monetary gold. This is the high point of productivity, but it never lasts. Stage 3 is where reality catches up with perception. The rest of the world stops pretending and officially crowns your money as the global standard. That's the moment of maximum glory and the moment the trap closes. For Portugal, that recognition came as merchants across Europe and Asia simply defaulted to the real for long-distance trade. For the Dutch, it was when Amsterdam's bills of exchange and guilder-based contracts became the safest, most liquid paper on earth. For Britain, the turning point was the early 1800s. After defeating Napoleon, the pound and the gold standard it anchored became the backbone of global finance. Loans, treaties, and trade contracts ran through London in sterling. For the U.S., it was Bretton Woods, 1944. 44 nations sat down and wrote the dollar's supremacy into the rulebook. Their currencies would peg to the dollar would peg to gold at $35 an ounce. The IMF and World Bank were built around that structure. Hostility could have a catch economists call the Triffin dilemma. To supply the world with enough reserve currency, the issuer eventually has to export money instead of goods. That means running trade deficits so everyone else can accumulate your dollars. Over time, the world wants your paper more than your products, and that's exactly where the decline starts. Stage 4 is where the empire quietly shifts from making wealth to spending it. At first, it feels like prosperity. Only later does everyone realize it was decay. Portugal slid into this phase in the 1500s. Instead of being the sharpest traders, they became heavy consumers, importing more food, textiles, and manufactured goods while financing it with gold and silver from Brazil. The empire looked rich, but its productive base was shrinking. The Dutch followed the same arc. After a century of dominance, the easy life in Amsterdam dulled their edge. Dutch capital stopped building ships and factories and started chasing loans and financial schemes. They became Europe's banker, profitable but parasitic. Glenn, in the early 1900s, was living off investments scattered across its empire. It imported more and more, while its factories lost ground to American and German competitors. The books still balanced because the returns from old investments filled the gap, until they didn't. The U.S. crossed into stage 4 in the 1970s. The trade balance flipped from surplus to permanent deficit. Year after year, America imported more goods than it exported and paid with newly created dollars and IOUs. Shelves stayed full. Standards of living felt high. But underneath, the country was no longer the world's workshop. It was the world's best customer, financed by its reserve status. Stage 5 is what always comes next. When deficits get too big, politics gets too weak, and printing becomes the path of least resistance. In older systems, debasement meant literally shaving coins and diluting metal content. Portugal did it when its finances were strained. Less silver in each real, more coins in circulation, same face value. Merchants weren't stupid. They demanded more coins for the same goods, and inflation took off. The Dutch did a late version of the same thing, quietly inflating the supply of paper claims and credit. Britain devalued the pound repeatedly in the 1900s, especially after the two world wars. Each reset slashed the pound's value against other currencies and gold, quietly taxing anyone holding it. JPEG, the modern US version, is more polite but no less real. Since 2008, and again after 2020, the Federal Reserve has created trillions of dollars through quantitative easing and emergency programs. Balance sheets ballooned. The money supply jumped. For years, inflation hid inside asset prices, stocks, real estate, collectibles. Then, after 2020, it broke into the open. Food, rent, fuel. Unchecked, stage 5. Use the printing press to smooth over problems that are fundamentally fiscal and structural. It feels manageable at first, but it always leads to the same next chapter. The world starts to lose faith. Stage 6 is not a single headline. It's 1,000 small moves that all point in one direction. We don't fully trust this currency anymore. For earlier empires, this showed up as merchants refusing to hold the old money or insisting on discounts. Portuguese reals gave way to Spanish silver. Dutch guilders gave way to British pounds. British pounds gave way to US dollars. In each case, the shift began before the official story caught up. Today, you can see the early signs around the dollar. Central banks are slowly trimming the share of their reserves held in US assets and diversifying into other currencies, and increasingly gold. Some major economies are settling energy and trade in alternatives instead of dollars. Regional trade deals now include local currency settlement, where the dollar would once have been automatic. None of this means the dollar disappears tomorrow, but it does mean the automatic, unquestioned dominance is fading. And once the belief that this is the only safe place to park savings cracks, the process tends to speed up. Stage 6 is a psychological tipping point. On the surface, not much looks different. Underneath, the global system is quietly rewiring itself for a world where one currency no longer sits unchallenged on the throne. Stage 7 is the moment everyone always insists can't happen, right up until it does. One day, the old reserve currency is simply no longer the default choice. A new arrangement or set of arrangements takes its place. Historically, the successor has been obvious: a rising power with strong industry, robust trade surpluses, and credible military reach. Spanish silver replaced the real, the pound replaced the guilder, the dollar replaced the pound. Each time, the baton passed to a single dominant player. This time is messier. There isn't a clear heir. China has manufacturing strength and trade weight, but its currency isn't fully open or trusted enough to anchor the world by itself. Europe's euro has scale, but sits on top of political and demographic fault lines. Gold is back in fashion among central banks, but it's too rigid to handle every transaction in a digital, high-frequency world. The more realistic scenario is a fragmented system. Multiple regional anchors, more trade settled in local currencies, and hard assets like gold used to square the books between blocks. That kind of world is more volatile, more political, and more dangerous for unprepared savers, because there isn't one simple, safe asset anymore. That's the world we're drifting toward if the pattern continues. All of this can sound distant and theoretical, until you realize who actually absorbs the damage when a reserve currency dies. It's not the politicians, it's not the central bankers, it's ordinary people holding the old money. When Portugal, the Netherlands, and Britain lost their monetary crowns, the elites mostly adjusted. They moved capital early, bought real assets, and diversified abroad. It was the middle class, the savers, and the retirees who watched their purchasing power quietly drain away through devaluations and inflation. You are living through a softer version of that process right now. If your wealth sits mostly in cash, bank deposits, fixed pensions, or bonds denominated in a single currency, you are effectively betting that system survives intact. Every bout of inflation is a small reminder of what happens if it doesn't. Restricting 2000, the dollar's purchasing power has eroded steadily. Since 2020, that erosion sped up. Prices for necessities jumped. Wages tried to catch up but lagged. That's what late-stage reserve currency decay feels like from the inside. You work just as hard, maybe harder, but your money stretches less and less. The global chessboard might decide when the next system arrives, but your personal balance sheet decides whether you face it as a victim or as someone who saw it coming and adjusted. So where does this leave you? Not in a panic and not in denial. Somewhere in between, in the small group of people who actually accept that systems change and prepare accordingly. The pattern across 6 centuries is brutally consistent. Military and trade dominance, export boom and wealth, forging formal reserve status, structural trade deficits, provoke deficits, money printing, clang, money printing, loss of confidence, replacement. The dollar is not at the beginning of that sequence. It's deep in the latter half. No one can give you an exact date for stage 7, but history suggests we are closer to the end than the beginning. Preparation doesn't mean abandoning your life, moving to a bunker, or jumping into every hype asset. It means gradually reducing reliance on any one currency. It means owning things that have value across systems, productive businesses, skills, real estate, selective commodities, and yes, for some people, a measured allocation to monetary metals. Most importantly, it means watching behavior, not headlines. What central banks do with their reserves, what trade partners use to settle deals, what savers quietly shift into, that's where the truth shows up first. If you can read those signals, you're already ahead of 99% of people who will blame bad luck when the next reset hits. If this changed how you see the dollar, history, and your own savings, that's the point. Reserve currencies don't last forever. They never have. And the people who get hurt the most are always the ones who assumed this time is different and did nothing until it was too late. You don't need to predict the exact year or the exact trigger. You just need to recognize the direction of travel. The dollar is no longer in its early explosive growth phase. It's in the late stages of the same 7-step cycle that took down the real, the guilder, and the pound. That doesn't mean America vanishes. It means the rules of the game shift, and unprepared players pay the price. On this channel, we're going to keep tracking those shifts in real time. Central bank moves, reserve data, trade agreements, gold flows, and the quiet structural changes most people never hear about until after the fact. If you don't want to be the last one holding a bag of slowly dying dollars while everyone else moves into the next system, hit subscribe, turn on notifications, and stay with this series. The pattern is playing out whether you see it or not. Your job is to stop being surprised by it and start positioning around it.